The 30-year Treasury yield just did something it hasn't done since 2007. It smashed through 5%, all the way to 5.336%. And if you think this is just about the Fed, think again. The real story is much bigger. It's about $40 trillion of debt, a global shift away from dollar assets, and an AI spending boom that's quietly draining demand for bonds. Stick around, because this changes how you should position almost everything in your portfolio. Let's start with what actually happened. Treasury yields have been climbing since 2023, but after March of 2026, the move went vertical. The 10-year yield jumped from around 3.945% to 4.746%. The 30-year surged from about 4.594% to 5.336%. That broke the 5% line and hit levels not seen since 2007. Some analysts are even calling it a new high for this century. Now here's the technical detail that matters. Traders call this a bear steepening. In plain English, long-term yields are rising much faster than short-term ones. And that pattern tells us this is not just hype about near-term rate hikes. It's structural. Fiscal stress, sticky inflation, broken supply and demand, capital getting pulled elsewhere, and geopolitics, all hitting at once. The result is a full repricing of the term premium. That's the extra yield investors demand for locking their money up for the long haul. And zoom out for a second, because this is global. Long-term rates in Japan, Germany, France, and the UK are all rising in sync. The low-rate, low-term premium world of the past decade plus is ending. And since treasuries are the anchor for pricing every asset on the planet, this repricing reshuffles the logic for stocks, bonds, gold, commodities, and cross-border money. The new normal is high yields with wide swings. Your playbook has to change from the roots up. So what's really driving this? Let's be clear up front. The core driver is not the Fed's next move. It's a systematic repricing of long-term risk. 4 big forces. Driver number 1, and this is the most fundamental one, the fiscal black hole. Federal debt has blown past $40 trillion. The annual deficit is closing in on $2 trillion. And here's the vicious part. A huge pile of old, low-rate bonds is maturing, and it has to be rolled over at today's much higher rates. Net interest payments have now topped defense spending for the first time ever. They're approaching, even crossing, $1 trillion a year. That makes interest the third largest item in the entire federal budget. And it creates a doom loop. Higher yields mean more interest. More interest means bigger deficits. Bigger deficits mean more bond issuance, which pushes yields higher still. The credit world is noticing. In May of 2025, Moody's cut the U.S. long-term sovereign rating to AA+. And the IMF is warning that America's so-called safety premium is fading. The whole idea of long-term treasuries as truly risk-free, it's being quietly eroded. Driver number 2, inflation just won't die. Core inflation has missed the 2% target for years running. Conflict in the Middle East has pushed up oil and energy prices. Upstream wholesale prices saw a massive year-over-year spike at one point. Services and wage inflation are proving stubborn. Even AI is adding pressure through structural demand for chips. So the market has fully absorbed a higher-for-longer mindset. But here's the paradox you need to understand. The policy rate has actually come down from its peak, yet long-term yields went up, not down. Think about how strange that is. The more the Fed hints at easing, the more the market worries about fiscal flooding and an inflation rebound. Rate cut expectations and long-term yields are moving in opposite directions. Driver number 3. Supply and demand are out of balance. On the supply side, the Treasury is issuing mountains of long-term debt, rolling it over quarter after quarter, and quarterly borrowing keeps coming in above expectations. On the demand side, the big buyers are stepping back. Central banks in China, Japan, and Europe are trimming long-dated holdings and shortening duration. The Fed itself is shrinking its balance sheet, passively reducing its holdings. Japanese money is flowing back home. And here's a force most people miss: the AI infrastructure boom. Tech giants are issuing huge amounts of ultra-long corporate bonds to fund their build-outs. That directly diverts the pension fund and insurance money that would normally buy treasuries. No wonder primary market auctions occasionally show stress. The government has to offer higher yields just to attract private capital. Driver number 4. The wild cards. First, monetary policy credibility. The confirmation process for the new Fed chair has been contentious, and markets doubt the policy path. That doubt feeds directly into a higher term premium and higher real yields. Second, geopolitics and de-dollarization. More countries are diversifying their reserves and cutting dollar assets. The Treasury market status as the ultimate safe haven is loosening, and investors now demand extra compensation for that risk. Third, that AI capital spending again. Ultra-long, heavy asset projects are competing head-on with treasuries for the same long-duration money. Let's zoom out again, put it all together, and the message is clear. This repricing of the term premium marks the end of the low-rate era. Yes, there's debate. Some say it's just a cyclical swing. Others say it's a structural break. A few radical voices even warn about a dollar credit death spiral, though that view is still controversial. But the mainstream consensus points to high-level volatility, not a quick reversal. So what does this do to your money? Let's go asset by asset. Bonds first. New issue rates above 5% could become the new benchmark. The curve keeps bear steepening. Short-term bonds stay relatively stable. Long-term bonds take the pain. Stocks. A higher risk-free rate compresses the present value of far-off future earnings. That's a direct hit on high-valuation growth stocks. Think tech, semiconductors, and AI names. Meanwhile, value stocks, high dividend payers, utilities, consumer staples, and energy look relatively stronger. Defense wins. And the equity risk premium, the extra return stocks offer over bonds, gets squeezed. Gold. Real yields are climbing, with 30-year TIPS pushing above 3%. That raises the opportunity cost of holding a metal that pays you nothing, so gold faces midterm pressure. But notice how its pricing logic is shifting. It's becoming less of a rate trade and more of a hedge against dollar credit risk and tail events. It would take an extreme geopolitical shock or a major policy U-turn to flip that trend. Commodities, industrial metals, and agriculture get dragged down by higher financing costs and weaker growth expectations. Energy is the exception, trading on its own geopolitical premium. Currencies and cross-border flows. Dollar assets look more attractive in the short run, but if fiscal fears keep growing, that long-term edge gets challenged. Emerging market currencies are under pressure. And here's an interesting one. Chinese yuan assets are starting to show mid to long-term allocation value, thanks to low valuations and deepening market opening. And the real economy? Mortgage rates and corporate borrowing costs are rising. Financial conditions are tightening. And somewhat ironically, that plants the seeds of a self-correction. Higher yields eventually slow things down enough to stabilize themselves. Okay, so what do you actually do about it? The core principle is this: cut your exposure to long-duration, rate-sensitive assets. Tilt towards stable cash flow, high dividends, low valuations, and defensives. Spread your currency and regional risk, and stay nimble with dynamic monitoring, because this market corrects itself. Let's break it down. On stocks, trim or underweight the long-duration growth names. That means AI, semiconductors, and innovative pharma, the sectors most sensitive to discount rates. You want to avoid the double squeeze of falling valuations and pressured earnings. Instead, rotate toward high dividends, steady cash flow, and earnings you can see right now. Value stocks, utilities, consumer staples, energy leaders, and financials. The whole rotation logic flips from paying up for growth to getting paid for defense and dividends. But keep one thing in mind. Asset pricing still comes down to underlying fundamentals first. Rates are a huge variable, but not the only one. On bonds, cut back long-duration treasuries and ultra-long bonds because rising yields crush their prices. Instead, favor intermediate maturities and high-quality investment-grade credit. Why? You're locking in genuinely attractive yields, a high-yield window we've basically never seen in the past decade plus. Keep an eye on auction results and any Treasury buyback operations, which act as liquidity support. Expect high levels with wide swings, not a one-way spike. On gold and commodities, build gold positions in batches on the dips. Do not go all in while real rates are this high. Treat it as credit insurance and a tail risk hedge, not a pure bet on rates. For commodities, be selective. Energy deserves some attention for its geopolitical premium. Stay cautious on industrial metals and agriculture. On cross-border allocation, modestly reduce your single currency dollar exposure and your U.S. growth stock concentration. Look at yuan assets for mid to long-term positioning, given low valuations plus deepening market opening. But pace it carefully. That opportunity depends on the U.S.-China rate gap narrowing and on global risk appetite. And stay alert on emerging markets broadly, where depreciation and capital flight are real risks. The big idea is more diversification across currencies and regions. So here's the plain English playbook for everyday investors. Lower your weight in long-duration bonds and expensive growth stocks. Tilt toward high dividends, low valuations, and dependable cash flow. Buy gold gradually on weakness. Add some yuan assets and other diversifiers to your overseas mix. And keep liquidity on hand so you can rebalance. Remember, rising yields tighten financial conditions all by themselves. That self-correction means the most likely path forward is high-level chop, not a straight line. Now, what could go wrong? And what should you watch? The risk list. The fiscal debt spiral accelerates. Inflation proves stickier than expected. Supply and demand deteriorate further. Geopolitics escalates. Confidence in policy keeps draining away. And this one's important. The financial system's weak links snap. History shows that when Treasury yields rise this fast and this far, hidden systemic risks tend to surface. Your monitoring checklist. Watch the FOMC meetings and the new chair's statements, especially the first meeting they lead. Track monthly CPI and PCE inflation, plus upstream price data. Follow auction bid-to-cover ratios and clearing rates, because they're the supply-demand barometer. Watch key levels on the 30-year. A sustained hold above 5.25% could trigger a more durable reset in stock valuations, and some market forecasts target even higher levels. Keep tabs on real yields, the steepness of the curve, foreign holdings data, and how much AI corporate debt gets issued. And monitor the scale and effect of any Treasury buyback operations. So here's the bottom line. This isn't a normal cycle. It's a structural shift. Long-term rates are likely to stay elevated for a long time, and the global playbook for allocating capital has already changed. The old assumption that low rates will always come back needs to go. What replaces it is a framework built on cash flow quality, duration management, and getting paid properly for risk. And recognize that policymakers don't have a magic wand. Rates, the balance sheet, fiscal repair, tweaking issuance maturities, every tool involves trade-offs across multiple goals. No single lever fixes this. And stay humble about the debates. Is the supply-demand imbalance really that severe? Where does gold go from here? What's the dollar's long-term future? Smart people disagree on all of it, so follow the data, not any single narrative. Quick disclaimer. This video pulls together publicly available analysis reports for educational purposes only. It is not personalized investment advice. Your actual decisions should reflect your own risk tolerance, time horizon, and the latest data, and when in doubt, talk to a professional advisor. One last thought. With financial conditions self-correcting and the whole world repricing in sync, the two things that still work are discipline and diversification. So what's your take? Is this truly the end of the low-rate era, or just another cycle that fades? Drop your view in the comments. I genuinely like to hear where you stand.